And good morning once again to all of our options traders out there. Happy Monday. I hope everybody had a great weekend. And we had a big day on Friday, October 20th, because the first time since 2007, the 10-year bond hit the 5% yield mark. All right, well, it technically wasn't exactly 5. That's the way it was reported on CNBC. It was just a smidge below that, but hey, close enough for government work. We basically hit 5%. But I've had a number of people say, what's the significance of a yield curve? Does it really show us anything? And as options traders, we probably don't pay as much attention to it as we should, but there's a really key insight to a yield curve that I find that most traders don't understand. So let's go find out what that is. And before we do, as always, please be sure to click like and subscribe. It's greatly appreciated and definitely helps to promote the channel. So the yield curve, I think most people know what it is, at least from a basic definition. It's simply a graph that plots the yields for various bond maturities. So you might see something like this. We've got the different years of the maturities across the horizontal. We have the various yields on the vertical. And so the yield curve will look something like this. It's going to be curved. And this just shows that maybe at a 1-year bond, we're going to get a certain yield. 2-year will be a little higher, 3-year, and so on. And then they will generally start to taper off. But this is why it's called a yield curve. It's not a straight line. But there are some times we can get very different shapes. We all heard about the inverted yield curve coming out of COVID. That's usually a sign of an upcoming recession. But there's a lot more that we can get from a yield curve other than just saying, hey, what's the 1-year bond yielding, or what's the 5-year bond? So what is the important insight to a yield curve? Well, to figure that out, let's jump over to an Excel spreadsheet and take a look at an example. Okay, so now we're into an Excel spreadsheet, and I've just made up some data here. These are various maturities ranging from 1 to 4 years. These are the yields. We've got 2, 3, 4, and 5%. And then we've got a couple other columns that we'll explain here in a moment. So the first thing to understand is that whenever you're looking at the yields, this is what you're going to see on the yield curve. These are facts. This is what the 1-year is yielding, the 2-year, the 3. Again, these are actual rates that we can go out and see in the market. But what most traders don't understand is that it's giving us a very key insight into what the market believes will be the 1-year rate in the future. So for example, let's say that we are investors and we're looking at a 1-year, maybe a T-bill and a 2-year note down here yielding 2 and 3% respectively. What is that telling us that the market believes will be the 1-year rate in 1 year? That's called the forward rate. And we can figure that out by looking at these rates. And here's how we're going to do it. If the 2-year rate is 3%, remember that's an annual rate, so you would be getting 3% per year or 6% for 2 years. Now, yeah, I know for all the math people out there, that's not exactly correct because we're not counting the compounding. But I think that kind of just muddies up the main idea. So to keep it simple, we're just going to add these together. So if you're getting 3% per year for 2 years, that's 6% after 2 years. Well, another strategy would be to buy the 1-year T-bill right here for 2 years, and when that matures, renew it, or what's called a rollover strategy for another year. And so the question is, what interest rate would you need to make those two choices the same, to where you'd be indifferent? Well, again, if you can get the 2-year for a total of 6%, or you could get the 1-year for 2%, you would need the 1-year rate in 1 year to be 4%. And that's what's called the implied rate. So by knowing that the 1-year is priced at 2% and that the 2-year is priced at 3%, we can infer that investors feel that the 1-year rate in 1 year will be 4%. Now you might look at this and say, that seems like an awfully big jump. The implied rate obviously for the first year is 2%, since that's the actual yield. Do investors really think it's going to double to 4? Well, again, that's a little bit of a misperception. They're saying it's an implied rate of 4% or 2 percentage points above the implied rate for 1 year, and 2 percentage points across 2 years would be 1% per year. And that's what we're seeing right here, going from 2 to 3. So it's called an implied rate because that's what investors would need to make these two choices indifferent. And we'll see why that's important in a moment and why that's a valid inference. But let's try another example because I know this can be confusing just in and of itself. Let's say that you're looking at a 3-year note and we see that it's paying 4%. Again, that's per year. So if you got 4% each year for 3 years, that would be 12%. Again, roughly speaking. Well, instead, you could buy the 2-year and get 6% and then renew for 1 more year, going from year 2 to year 3. So how much of a yield would you need if you've got 6% and you could have had 12% by buying the 3-year? Well, you would need an additional 6%. So the implied 1-year rate in 2 years is 6%. And so we can just continue on down the line here. For the 4-year, the yield is 5%, but the implied rate is 8%. Why is that? Well, you could get the 3-year bond and get 12%, or you could get the 4-year for 5% and get 20%. And what's the difference between 12 and 20? You would need an additional 8% from year 3 to year 4. So that's how we're coming up with these implied rates. Now over here to the right, we're looking at the average. So the average of 2 just in this first row is obviously 2. But if we look at the average between these, 4 and 2 would be 6, divided by 2 would be 3. That's the average. And that is exactly how the market is pricing the 2-year note. What's the average for the first 3 here? We've got 6, 4, and 2. That's 12 divided by 3. The average is 4. And that's exactly how the market is pricing the 3-year note. What's the average for all 4 of these? Is 5%. That's just taking 8, 6, 4, and 2, adding them up and dividing by 4. So the average is 5% of these implied rates, and that is exactly how the market is pricing the 4-year note. So again, what the yield curve shows us right here, remember these are actual numbers that we are observing in the market. It's showing us what the market thinks the 1-year rate will be this far down the line. So for the 2-year, what will the 1-year rate be in 1 year? For the 3-year, what will the 1-year rate be after year 2? And so we can just keep working down the line. And that's really a key insight to understanding a yield curve. Now, because of this, we can also get an even deeper insight. By looking at the yield curves, we know that, for instance, the market feels that 3% will be the average 1-year rate over the next 2 years. By looking at the yield curve, we can also see that the market feels the average 1-year rate will be 4% over the next 3 years. And then finally, the market feels that the average 1-year rate will be 5% over the next 4 years. Now, we can also drill down. We could say that if the 1-year rate is 2%, that the market feels this will be the average rate per month over the next year. So it's the same idea no matter which yield that we're looking at. It gives us some very key insights. Okay, so that might seem a little far-fetched. You might say, how can we infer that the market feels that the 1-year rate in 1 year will be 4% just by looking at these two actual pieces of data? And that's a really good question, and this is where things get even trickier. And so to figure that out, let's jump back over to the presentation. Okay, so for just a quick review, let's limit it to just 2 different issues right here. We have a couple of notes. One is the 1 year for 2%, and the other is the 2 year for 3%. Let's say that you have a 2-year horizon. That's your real need. Well, if you do that, as we just found, you can take the 2-year, and after 2 years, you would have a total of 6%. Again, not counting the compounding. Just to keep the math easy, you're going to have 6% after 2 years. But you could also choose to take the 1 year get 2% on your money, but now you're at the mercy of the market. You're going to have to renew or roll over that bond after year 1 for another year to get you to year 2. So if you are hoping to get that same 6%, what would the rate have to be in 1 year? That's how we figured out in the previous Excel demo that it would have to be 4%. So now we're saying that investors must be implying or inferring that the 1-year rate in 1 year is going to be 4%. Now again, how can we infer this? Why does that even make sense? Well, here's why. You've heard me talk about this in previous videos, that price is the equalizer. That's how we can come up with these insights, by looking at the current data. So here's how we know that the market must think that the 1-year rate in 1 year will be 4%. Let's say that instead, investors collectively thought that rates are going to rise. They don't think that rates are going to be 4%, maybe they're going to be 5%. Well, if that's true, then investors should choose the rollover strategy. They should choose the 1-year bill right here for 2%, and then if they are correct, let's say that they can roll it over for 5%, which would give them a total of 7%, which is certainly better than 6%. So how do we know that that's not true? Well, if it were true, instead of seeing 2 and 3% for the 1 and 2 years, we would see something like this, 1.5% and 3.5%. So why would we see this? Well, think about it. If you could buy the 1 year and get 2% and then be better off by waiting for the rates to rise, what's that going to do? It's going to set off a chain reaction in the market. Investors are going to start flocking for the 1 year, pushing its price up and therefore the yield down. And conversely, they will either start backing away from the 2 year, we'll start to see a lack of demand, which will push its price down, or they might even start shorting that bond. So that's going to put downward pressure on its price and upward pressure on the yield. And so that's why we would see something like this. We're not going to see 2 and 3%. The 2 year would be something less, again, maybe 1.5%. And the 3 year would be something more, maybe 3.5%. So for example, let's say that the investors push the yields on the 1 year down to 1.5% and up to 3.5% on the 2 year. Well, what would happen now is you could invest for 1 year, let's say at 1.5%, and then if rates do in fact rise to where you can get 7%, that would now give you an implied forward rate of 5.5%. But the point is that if investors are correct that this implied rate is going to be larger than 4%, you would see these numbers change. You're not going to see 2% and 3%. This number here, 2%, would get pushed lower, maybe 1.5%. This one would get pushed higher. But that's not what we're seeing. Because remember, these are actual correct numbers. These are facts. If we're seeing 2% and 3%, the only way that that can exist is that market participants must feel that in 1 year, the 1 year rate will be 4%. So the thing to remember from all of this is that the yield curve shows what the market expects the 1 year rates to be on average over the bond's term. So for example, if we see the 1 year rate, those are the expectations of the average monthly rates over that year. If we are looking at a 1 week rate, those are the expectations of the average daily rates, or what are called the overnight repo rates. What are the expected averages per day for that week? So now that you have those insights, what does it mean when the 10-year bond now hit 5%? It means that the market now thinks 5% will be the average annual rate over the next 10 years. And for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a brand new candlesticks and technical analysis course. You can find it all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.